Happy Monday, everybody. Welcome to the TraderMerlin Show. Hope you had a great trading session out there. I see we've got a pretty full house. Some names I haven't seen in a while. We got Mesnok joining us. We got Eric as well, Tomasino, Jeff. Shane Anthony says he finally gets to appreciate the show in person. Well, good. I hope that house flipping is going well for you out there, Shane. Good to have you with us, Zach, Katut, Ivzi, Siraj. Of course, Les starting things off with Mario and Ken and Chris, who's probably stuck on the side of the road. I don't know if you're stuck, Chris, because you're old classic cars, or you're just taking a safety break on the side of the road. Either way, I hope you're doing great up there, my friend. Good to have everybody with us today. We're going to take a step back and look at the big picture. Obviously, this show kind of goes through all sorts of different topics, and wherever you guys decide to steer the show is normally where we go. But once a month, I'm trying to bring on a friend of mine, Scott McCormick, who's a CMT, which is a Chartered Market Technician, to talk about what he calls the B.E.C.C report. And the B.E.C.C report is essentially just how these asset classes tie together and what clues they can give us maybe about the strength, weakness, or indifference of an overall market when we look at bonds, equities, currencies, and commodities. So joining me from the great state of Tejas, we've got Mr. Scott McCormick on the phone. How you doing, Scott?
Hi, Merlin. How are you?
I'm wonderful now that you're on the show. I've been doing so many shows by myself. It's nice to have someone to talk to.
No, yeah. I was looking at our last chat. It was like June 15th. I'm like, all right, yeah, it's time.
We missed July. I thought we were like, okay, we'll do you the first week of the month, but I've been so dang busy, and I hate to bug you, but I know you love talking about markets, so this is a win-win for me.
It's always a pleasure.
What's new in your world? Anything fun and exciting going on?
We're actually taking a trip next week to Colorado Springs. We're going to go up to Pikes Peak and do some hiking and stuff, and so I'm really looking forward to that. My dad's side of the family is from Colorado, and I have not been there for a visit since 1982.
Oh wow, really? Man, I tell you what, Colorado Springs.
Colorado
Springs is not what you remember it.
Yeah, no. They're more from like the Aurora and Denver area. So it's going to be an interesting trip. My first time to Colorado Springs.
Sure, a lot of fun. Well, shoot, if you're going hiking, I just told you I got some electric bikes, man. Who's screw hiking? You can just ride up those hills.
Just right up the mountain.
Just ride up, and everybody's cursing at you. You zip by them doing 20 miles an hour.
You're cheating.
You're cheating. All right, well, let's get into kind of the meat and potatoes of it. Obviously, we could probably start high level and talk about the Fed and what the Fed's doing, but we always tend to get close to running out of time. So let's dive into the bond markets as that kicks off your B.E.C.C report. We've seen yields kind of oscillating back and forth, no massive swings on those yields. What are you getting from the bond market now?
So when I look, I think it's important for your listeners to kind of understand the perspective that I take, because you mentioned a moment ago the Fed, and obviously monetary policy is going to play an incredible role in not only what the bond market does, but what the stock market does, and commodities and currencies for that matter. But when it comes down to it, I look at everything from a macro technical perspective. Mm-hmm. And what I mean by that is that when I go through the charts, I'm not just looking at like a daily chart going back 6 months or something like that. I'm actually looking at monthly charts and weekly charts that are going back decades. When I set up my charting platform, the monthly charts, they'll go back like 90 years. And wow. I have them set to go back 90 years. And the reason why is because not only do I want to see the longer term trends, but it allows me to kind of go back and look at different periods in time throughout history where maybe we had similar market conditions, right? Mm-hmm. And so, when I'm looking at the interest rate market, especially going back into like the very beginning of this year, there was a lot of talk, and there still is talk about inflation. But going into like the first quarter of this year, like it really started to kind of grab people's attention. Right. Everybody was talking about it. And what we saw was basically interest rates kind of came up to that 2.4 on the 30-year, 2.4 area, and since then, and when I say since then, since about March, it's just been backing off.
Yep.
And you and I have had this conversation before that it's important for us to have a long-term perspective, and when I look at trends, regardless of whatever instrument I'm looking at, I always look at it from a couple of different perspectives. One, what direction is it going over the long-term trend? And then two, what's its current phase? And so what I mean by that is that you can have, for instance, in the bond market, a situation where the long-term trend is down. If you play connect the dots with all the peaks,
Yep.
you could draw a trend line down over the course of the last 40 years.
And I have that up there right now. So I've got your 30-year trend. It's funny because if you were to zoom in just, since 2020, it looks really bullish and everything. But then you step back, and the more you step back, the more you're like, oh, well, shoot, this is just a pullback in a massive downtrend.
And that's really kind of my next point, because that rally that you've been pointing out, because we did see interest rates kind of bottom out there in early 2020, like actually March 2020, and since then they've been rallying. They rallied for a year basically before kind of topping out a few months ago. But it's important to understand that that short term, or that trend up over the course of last year, relatively speaking, is short term, especially from the perspective of the Fed. Because when they are going through their monetary policy decisions, they're not trying to like micromanage the economy. It's like they want to obviously support the economy and making sure that inflation is not too hot. They want to make sure that it is, we have full employment, et cetera. That's their dual mandate. And obviously the decisions that they're going to make sometimes, it can be an overcorrection on their part, an overadjustment, if you will. But they're trying not to do that, And so when I'm looking at these multi-decade charts, and I hear the Fed saying things like, well, we think that this is just kind of a short-term spike in inflation, I can see why they would say that.
Sure.
Right? Whereas everybody else would be like, are they off their rocker?
Yeah.
And who knows? They could be. They could be wrong. But when it comes to the interest rates, in order for me to really kind of see that this long-term downtrend in the 30 years is over, I need to see that interest rates on a monthly basis close above like 3.5%. And
people think, if you think, a lot of people think at 3.5%, it's like, oh, good God, are you crazy? And I think I think this is from the show that you did, I want to say back in 2019, maybe 2020 on this show, where you talked about kind of the line in the sand, which is kind of between, 350 and 4, where, we haven't been above that for 10 years. And that's that point where you're like, okay, if we get above that, then maybe this giant downtrend that we see, and I'll zoom out again for everybody, is now broken, and the potential for things to move the upside. But honestly, given the pressures and all the different political BS that's going on out there right now, do you really think that there's an incentive to get these rates up that high, or a need? I mean, it seems to me like they'll keep pushing them down.
Well, okay, so if we start to really kind of look at it from a finance perspective, right? Government issues these bonds to borrow money effectively, right? I mean, they're loans. And so if you're running a deficit that's trillions of dollars, are you going to want to pay higher interest rates? So it's really going to be, it's going to behoove them to keep the interest rates as low as possible. Exactly. And so long as there's not a real shift in demand for these products from international markets, and I say international markets because that historically has been who a lot of your big buyers have been. But if we don't see a shift in that demand in a way that if they perceive that there's a higher risk, and then what you are going to start to see is that the interest rates are going to go up. It's not just inflation, right? Because now it becomes a higher risk of potentially default, right? So you start to get into a lot of different aspects of the bond market. Maybe Bill Addis would probably be able to talk about this from a more informed perspective. I mean, but for me personally, when I'm looking at the 10-year and the 30-year, and I see that the interest rates are going up, again, it was just kind of a short-term blip for now, right? But it's important, I think, for your listeners to know that, I look at these charts every month. I wait for the monthly candle to close. So, at the beginning of August, I'd go through and look at it and be like, okay, well, where do we close this month, right? And then I'll set lines and so forth with alerts so that if anything happens between, August 1st and September 1st, I'm alerted to the fact. It's like, oh, we're finally moving across this area. and it's kind of funny because, I rely on alerts heavily in my analysis and my trading, and if nothing is going off, if there's no alerts, I don't do anything.
Right.
Right.
Well, and that way it's great because you're not torturing yourself by forcing trades or sitting in front of your computer like making something happen. And it's what's that old phrase? A watch pot never boils, and it's kind of that attitude. Yeah. I have the same perspective as well. I do a lot more with alerts now because I can sit here and look at any price chart and I can force a trade. I can make it happen, but I'd rather it fits the big picture of what I'm trying to accomplish in that trade. So I love alerts as well.
Yep.
All right, so bond markets still big picture trend to the downside. Equity markets is a completely different story. This is one that's got me scratching my head a little bit. You see, I'll bring up the charts here. We got everybody, the S&P. I've got the monthlies on here just so you guys can see it. This is on pace to be the second year where we had every month is a higher high, which is kind of rare in the equity markets. In 1995, as I mentioned, guys, is the last time we had the S&P close every month high for the year. Right now, you're looking at a 0.21% gain for the day, but what's noteworthy is it was beaten up today, then ripped to all-time highs. You look at the NASDAQ. NASDAQ was getting just slaughtered today. Well, it's just about back to all-time highs. You look at the Russell, and it's a different picture. It's just the sideways traversing. Does the, I guess, discrepancy between the Russell and the other major indexes concern you at all?
That it does, actually. And so, if part of my process is to do that relative strength comparison. And so one of the things that you just kind of pointed out a second ago is that like the S&P was up 0.21% today after being down earlier in the session. So it was actually a very strong recovery there today. But when I do a relative strength comparison, what it is an actual ratio as opposed to just a percentage change chart comparing, how much one has gone up or down over a certain period in time. And what I've seen here from the asset class perspective, actually comparing, say, the Russell 2000 to the S&P 500, it's been underperforming since the first quarter going into the second quarter of this year. Not the first time it's done that, by the way, right? But there's an old adage that small cap stocks will lead going into a bear market, and they will lead coming out of that bear market, right? So they usually lead going into a bear, they lead going into a bull. So when I'm looking at the relative strength chart and I see that it's underperforming the S&P 500, it's kind of like a yellow flag on a racetrack, right? It's caution.
Yep.
If I see that it's outperforming, much like what it was back in the fourth quarter of last year going into the first quarter of this year, it's like, okay, it's just a green flag, everything's a go. So the other part of that, though, is that when you start to get into the analysis of the charts, the S&P 500 obviously has been making all-time highs. I was talking about this morning in the guided pathway session because every Monday we always do a weekly market overview. On the first Monday of the month, we'll do a monthly market overview. But the Russell 2000 basically has been in the same range of price as March of this year.
Yep.
Now, we've seen monthly closes that are higher, but we haven't seen a monthly close above that March 2021 high at about 2360. I'm actually looking at the cash index.
Yep, 2368 was what I got.
Yeah. So, the fact that the Russell isn't like breaking down is the one kind of saving grace in this situation. But if you start to pay attention to the short-term price structure, and we do break down below the range, like that 2080 area for the Russell, then it's probably going to become a little bit more of an issue from a macro market perspective, if you will. I'm just going to throw that term out there. So part of the reason why the Russell 2000 is underperforming the S&P 500 isn't because it's going down in price, it's just because it's going sideways, right?
Right.
So from a portfolio management standpoint, what would you do with that? Well, let's say, for instance, if you have the equity portion of your portfolio, let's say 25 or 30% of that is allocated towards small cap stocks. Well, in an environment like this, you're going to do one of a couple things. One, instead of having that 25 to 30% exposure, maybe you would have 12.5 to 15%, right? Mm-hmm. So you're reducing that exposure in a way to where you can then take that extra money and put it into an asset class that is outperforming, aka S&P 500. But the remaining portion of that money isn't just going to be invested, for instance, in the Russell 2000. You would seek out those stocks that are strong within that index, and of course within strong sectors, in an effort to try and outperform that area. Because if you just follow the index, you're just going to get index-like returns. And
right.
So that's part of the process that I go through in the back report, is to figure out, okay, where's the strength? Where are the markets currently? What are the key technical levels that especially would indicate I'm wrong, right? Mm-hmm. Or that there's a change that's taking place, kind of like that 2080 area in the Russell 2000. I know that if we start trading down below that, okay, we're probably moving into a bigger correction. I doubt it would be something like what we saw in the first quarter of 2020, but it could be a little bit more along the lines of what we saw back in 2015, 2016, or back in 2011, right? Because there are and have been instances over the course of the last 2 decades where we have seen small cap stocks underperform large cap stocks on a pretty big scale. So almost, the second half of 2018, all of 2019, going into the first quarter of 2020, only to really kind of become leaders again. And so it's just one of those things where you have to just stay on top of it. But when I say stay on top of it, I'm checking this data on a monthly basis, and when I do go in and I make any trades, I'm double checking it on an intra-month basis. But again, if I have any alerts that go off, between August 1st, September 1st, whatever it is, then I know, all right, something's up. I need to go revisit that.
It's tough because it's one of those historic reference points, historical reference points of strength or weakness in the market, and people always call the Russell that canary, the proverbial canary in the coal mine. Yeah. And you look at it really since March, it's been in that tight little range, and so that for me was pause. I'm like, okay, well, I'll keep more of an eye on the Russell. Yet I've sat here and watched the S&P, the NASDAQ, and the Dow just go absolutely gangbusters and keep on making highs. It kind of makes you wonder, well, is it just the Russell that's broken? Is it just that the money's pouring into these large cap, mega cap stocks and leaving Russell behind? Not necessarily that the Russell is going to tank, but it's just not getting the cash inflows that maybe the big indexes are, because that's where the trend is strong, and at some point one of them's going to end up breaking.
You're correct, and when looking at other parts of the market, right? So, kind of stepping away from just looking at price charts, for instance, and looking at how an index is actually structured is one of the things that I tend to focus on quite a bit. And so, looking at the S&P 500 on a monthly basis, I'll go in and actually look at what percentage of that index is in each of those 11 sectors, so that if I see, for instance, the S&P 500 is going up, and the biggest sector right now is technology, but technology isn't really kind of going up as fast as what it has been, then it calls that rally into question for me, right? Because I try to identify, like, where's the strength really kind of coming from, and is that strength kind of across the board, or are we really just kind of dealing with like a few sectors? And what's kind of concerning for me is that the strength in this rally, especially over this last year, we've seen a little bit more of a quicker sector rotation back and forth. Whereas if we were to go back a few years, like, I say a few years, probably closer to 5 years, consumer discretionary and technology were like the leaders, okay? And those were also very heavily weighted sectors within the S&P 500. So it makes sense that the S&P 500 would be doing what it's doing. And then you take a look at an area like energy or materials, that are completely underperforming, but they're also a very small portion of the S&P 500. So they're not going to be as much of a drag. But when I take a look at the relative strength analysis right now of the S&P 500, it's very much a mixed picture. Like, technology has been performing with the S&P 500 for most of this year. There has been periods of weakness. We saw some strength last year in materials and industrials, which would be a little bit more indicative of a longer term sector rotation within the economic cycle. Same thing with energy. But that has kind of given way to some weakness in those three sectors over the course of the last couple of months in particular. But one thing that is notable is healthcare. Now, healthcare has been doing really well. I mean, if you just look at a chart of like the XLV, it's been making all-time highs for months now. But what is striking is that from a relative strength perspective, it's actually been underperforming the S&P 500 until about a month ago. Now it's starting to see signs of strength. And to me, that is good for a couple of different reasons. The second one, it's just a strong sector. So that's reason number one. Reason number two is that it's the second most heavily weighted sector within the S&P 500. So when I look at the S&P and I see, okay, strength is coming into the market from this big sector, that to me is good. It should help bolster or hold the market up, even if I see weakness in other areas. Does that make sense?
Yeah, absolutely. I mean, it's tough when you have to step back and look at these, because it's hard to look at a chart like healthcare right now and go, it's underperforming. You're looking at it going, good God, this thing's it's ripping. It's up almost 100% since those March lows, and here we are going, it's underperforming. It's like, come on.
Yeah, it's ridiculous when you look at that, and you look at the relative strength, and you're like, how is that underperforming?
Yeah.
And so it's a horse race thing. Whenever you're looking at relative strength analysis, just think of it in terms of a horse race. There's 11 horses in this race, and it's called the S&P 500 race. And what I do is go through and pick, who's the strongest horse.
Sure.
And so XLV, it's going in the direction of the S&P 500, but now it's starting to kind of come up from the back part of that pack of horses. It's gaining some speed.
And it's coming around the home stretch, and we got SLV. Bringing up the rear. XLE losing some speed in the background there. Oh boy, it can almost have how they do it at the baseball games, where they have the M&Ms running around, or the hot dog, and all they're running around. And you have to kind of make the wedge. You could probably do that with this. Just create some game where you have the 11 sectors just going on a little chart, and you could bet on them. There you go. It's called the stock market. All right, so we've got a good sense as to kind of overall markets with the equity side of things. Currencies is a very interesting one for me, simply because that dollar index, it was looking so weak for so long, and all of a sudden it just seems like it's stabilized over the past year. It's maybe gaining a little bit of strength. So maybe we can start there, and if you have any thoughts on any international currencies.
So it's, we look at in the guided pathway session every morning, we have a very specific routine that I go through. And so Tuesday through Friday, I look at the dollar index like every day, and I feel like a broken record sometimes when I go through it. But the very interesting thing about the dollar index is that if you were to look at a monthly chart going back, the last 8 years or so, and not even 8 years, like 5 years, you can see that the dollar has really kind of been in this range between 103 and about 88 and a quarter. But we see this weakness over the course of last year, only to come back to a demand level, right? And so what we're watching for right now is whether or not we actually see a breakout above the highs from back in March at about 93.5. We get a weekly close or a monthly close above that. That would indicate to me that the short-term downtrend that had been in place since April of last year has officially terminated, and we're more likely to move back up towards the upper end of that range and around that 102, 103 area.
Yep.
Now, with that, what are the implications? Okay, and so this is what part of this process would prepare me for. So historically, strong dollar would mean weaker commodities. Now, it doesn't necessarily mean that commodities can't or won't go up during a period in time when we see a strong dollar, but they might not rip higher like what we saw last year with gold. Last year, I mean, gold just had this massive move going back up into 2000, and it's only come back down since, right?
Yep.
Same thing with crude oil. You know, we've seen a lot of strength in crude oil here over the course of last year. Now, of course, on the other hand, if we see that the dollar index breaks down below that 88, then, you know, I'm looking for this thing to get back down to around that 81.48, in which case, you know, I would expect some stronger stronger commodities. Now, of course, you know, anybody else listening to this would be like, all right, well, thank you, Captain Obvious. You know, which one is it going to be? And the thing is that I don't know what it's going to be, right?
Right.
So I have to prepare myself for that. I always joke about it. It's like the only thing I can guarantee is that the market's going to go up, down, and sideways, right? And the best thing you can do is be prepared for all three of those scenarios. And so if I were to see, you know, that dollar index start to break out, then yes, I'd start paying attention to some of the commodity currencies like the Canadian dollar or the Australian dollar, right?
Yep.
Because those are both kind of heavy on the gold side, but also, you know, Canadian dollar obviously on the oil side as well. So as I'm looking at the dollar index right now, I'm not like overly bullish or bearish on any specific currencies. If anything, I'm more neutral, right? You know, because if you were to take a look, for instance, at the Canadian dollar here, you know, the thing about it is that it's really kind of been in a big sideways range since about 2016 as well. It's recently come back down to the bottom side of that range, which really kind of started back in early to mid 2015. You know, so we're at a couple of make or break moments here as far as the currencies are concerned. But you know, watching the stuff from a monthly perspective, I think is pretty important. What's also kind of weird, you know, just pulling up the Aussie dollar chart, kind of looks like crude oil. If you look at it, it almost looks like crude oil.
I'm bringing it up here.
Really weird.
The Aussie.
Yeah, AUD USD.
Yep. Let's see if I can do it. For some reason, TradeStation decided to be real jerks with me, so I don't get all the data. They're trying to make me a professional now, which, come on, no, everybody knows I'm not a professional. Come on. Yeah, and I can't pull up crude oil, so I won't be able to do that comparison on this chart.
Okay.
Dang it. But we can look at it on this TradingView, which is going to give me some free charts. There we go. Right, so there's your Aussie, and I will see if I can get crude oil on the same piece. There is your crude oil. Boom. Yep, very similar. Now, on that note, I know commodities is the next piece. We kind of dripped on a little bit of that. But like right now, we're at this point on the monthly where crude oil came right back up to those highs you saw back in 2018, right? And it bounced right up to it on a super aggressive move from negative $40 a barrel. I mean, come on now. That's just crazy. But does that change your perspective if something's coming into that solid of an area of supply? Or
so, you know, again, couple of different things here. Going back to the longer term trend, I mean, coming in from 2008, there was a very key event that took place in February and April of this year, which was a monthly close on the other side of that down trend line. Now, trend line breaks should be recognized for sure, without a doubt. But the other part of trend analysis, in my opinion, is recognizing the swing highs and the swing lows that really kind of define where that trend line would be drawn to. And the reason why I'm saying that is because you can have a situation where a trend line is broken, but what that's really indicating is that the speed of that trend is changing, not necessarily the trend itself. And
well,
so
it's just giving birth to a new trend. It make, you know, and that's something I talk about quite a bit, and I'm glad you brought that up. It's like you can have a 45-degree sloping market, and all of a sudden it breaks that 45-degree slope, but now it just goes up in a trend line that's at 30 degrees. It's still a strong uptrend, just not the same intensity.
Right. And so, you know, in the case of crude oil, it's still a downtrend, but not the same intensity.
Right.
And the key level that I'm really kind of watching is the high from 2018, which on a continuous chart was around 76.90. So getting a monthly close above that really is going to open up for a wide new world of possibilities. And I say it that way because it could be the beginning of a bull market, much like what we saw back in the 2000s.
Wow.
You know, I don't know that that's going to be the case, but So if you are looking at a monthly chart of crude oil right now, what you will notice is that in essence, we are trading inside of last month's range. So, from a short-term trading perspective, like the signal that I would be watching for, knowing that we're at a supply area in the market, is if I start to see closing prices on a daily basis below 73.95, which is last month's low, then I know that the short-term uptrend that had been in place, for instance, for the last 4 months has been broken. We're going into a corrective phase relative to the uptrend that's been in place since May of last year. But the real kind of moment is going to be if we see like a weekly to a monthly close below the low of March of this year at about 57.25, which is pretty far off from where we are right now. I mean, a short-term trader is going to like, dude, that's 10 points away, But from a monthly perspective, 10 points, that's nothing, right?
Yeah.
So seeing a close below those areas would tell me that the uptrend that's been in place since last year has terminated, and I need to start looking for some new supply zones to try and get short on crude oil from a longer term perspective.
Yeah, no, I think your 76.80 mark, 76.90 mark, you're right. If you're looking off to the left over there, if it breaks above that, there really isn't anything that's clear, unless I maybe split this into a weekly or a daily time frame. But it's just smooth sell off in 2014. Like about 100 plus mark could be achieved very quickly.
You're going to be looking at about 97 to 108. And then beyond that, I don't want to see this, but having crude oil go back up to 147 would be a possibility.
Oh, come on! You drive a Prius.
No, I don't.
Are they even allowed in Texas? I thought you'd be shot for driving a Prius in Texas.
No, they are.
That's just because all the Californians are moving to Texas.
That's part of it, man. A lot of the younger generation too. They're those millennials, they're a little bit more mindful.
Yeah, are they? Okay, just good
here. Yeah,
good to know. All right, so we look at bonds, equities, look at some currency pieces, look at some commodity pieces. One thing I found interesting with the commodity space is with this inflation talk, right? And I've seen a lot of comments from the big prominent talking heads in the financial world, and a few of them going, look, you have to take the inflation trade right now. You have to take, and basically the inflation trade is just buy gold. I mean, just to go towards that safe asset. Now, if that's the case, I'm looking at gold. I'll see if I can bring it up for the viewers at home so y'all can see that. Yes, I did say y'all because Scott's on the show today. I want to make sure he has a southern feel. We're fixing to look at some charts here. I've got the monthly up here, and it looks like, for all of 2000, pretty much all of 2020 and 2021, really nothing that spectacular, right? We peaked out at that 2088 mark on gold. If there really was, in fact, a discernible inflation number, wouldn't gold be much higher than current levels?
I believe so.
Yeah.
And it's, I don't want to say it's funny, but, because I there's nothing worse than like making a public call about the market and then seeing it do the complete opposite, and I forget who it was, and I probably shouldn't say anyway, but this was a big talking head who publicly announced that they had just sold one product and they just bought a bunch of gold, and it was over the course of the next couple of days where we saw gold just absolutely plummet. This was going back earlier to I guess the 6th and the 9th of this month, where we just saw that big sell-off. And what's interesting is that when you do look at the monthly chart, right, there was this area of demand that we had been watching at about 1775.80 to 1671.70, and we've come pretty deep into that area. But structurally, if you are paying attention to those monthly charts, really to kind of confirm that we're back into an impulse phase within the context of a longer term uptrend in gold, you have to see it get like a monthly close above 1919, right? So, we're kind of, again, like the dollar, we're in a bit of a no man's land.
Yep.
If you're shorter term, dropping down to like the daily charts and stuff like that, key area is going to be around 1835, because that would certainly break the minor downtrend that's been in place since June. And on a continuous chart, we didn't get down below the lows from March, but on a front contract we did. So it kind of calls into question whether or not there's actually any remaining unfilled buy orders there. But a lot of the buying that we've seen here over the course of the last 3 or 4 sessions, most likely short covering. So the question is that when the market drifts back down again, do we actually see a bid kick into the market to try and initiate new long positions?
Yeah, it's been a great bounce. We were looking at that level too on this 1673 on this show, and I actually was long on some calls and then got stopped out of it and jumped back into it. So I'm enjoying the move up. It's erasing some of the losses I took on my previous trade. So.
Yeah, if we do see gold get down below 1671, then it opens up the possibility of actually getting back down to about 1240 to 1162. Maybe we'd see a little bit of a bounce around 1378. But one of the other things that I pay attention to in my asset class relative strength analysis is doing that comparison of gold to the S&P 500. And basically last year during that rally that we had going into August, that relative strength ratio was actually pretty strong going into April. But going into the August high for gold, that relative strength ratio was weakening and basically had like a trend termination or reversal going into November of last year. And since then, it's been underperforming the S&P 500. So the reason why I bring this up is because if there really was that fear of an inflation trade, it would be my opinion that you would see more money going into hard assets versus paper assets.
Right.
And that's really what this ratio is designed to do. And that's, we saw that basically back in like 2007. Gold started moving up like around 2002, 2003, but from a relative strength standpoint, we really saw that strength kick in from fourth quarter 2007 going into the mid part of 2011 before it finally topped out. Yeah. So right now, I know that people are talking about inflation, and I'm not saying that it's not something to be cautious about, concerned about, plan appropriately, but so far there's, from the data that I'm looking at, I'm not going to be too worried about it right now.
Yeah, well, it's funny. We've seen a lot of things correct. I mean, probably one of the most amazing charts of the past, in my mind, really like the past 10 years. No, it's not looking at Nikola Motors, which is just a garbage company, in my opinion. I'll bring it up here. It's the lumber futures chart, and this is just absolutely jaw-dropping. We talked about this during the rally up on how crazy it was and the inflationary pressure. To put it into perspective from, let's see, where we're at right now, right around 460. That was on October 26th of 2020. We're not even a year in, and it's gone from 465 all the way up to a peak of, let's see, that high was exactly 1733. I mean, that's a $1,300 move up in random lumber lengths, and then all of a sudden it's giving it all back. And it's right back where it started. I mean, that's a crazy boom bust. That's like tulip bubble type stuff. But
it really is. I think if you were to overlay a chart of tulips,
looks just like it,
from the 1600s, it'd be nearly identical. So it's a fascinating thing, and I think that when you look at this, I mean, yes, there's going to be like solid economic reasons as to why lumber prices were going up or going down, but I think a lot of that parabolic movement that we saw going into, kind of mid-year this year, the second quarter going into May, a lot of that is just one, speculation, two, short covering, because you have to, and possibly even hedging as well, because from a commercial standpoint, anybody that's actually buying lumber, they're probably going to be hedging the crap out of that when that market is going haywire, because they have projects that they've budgeted out for. If you're a contractor during that period of time, God help you.
Oh yeah, if all of a sudden your primary commodity for building a house jumps by 4x, that's crazy.
Yeah, your profit margin's gone.
All right, talk to me about, let's wrap things up. I know we're going to go long again, but GPS, how can they join those and what times?
So the Guided Pathway session is Monday through Thursday, I should say. The Guided Pathway session is a special session where we spend about an hour to an hour and 10 minutes with students, kind of prepping them for the market every day. And what my role is to take them through kind of the big picture, much like what we're talking about, But depending upon the day of the week, I'll have more of a focus on equity indexes, equity index ETFs, and sector ETFs like we did today. And we'll look more at like the weekly, daily, and 60-minute charts on Mondays. But then Tuesday, Wednesday, Thursday, Friday tends to be more focus on futures, and we'll look more at the daily, the 4-hour, and the 60-minute charts, trying to get a little bit more of a micro as opposed to a macro picture. And then on Fridays, the reason why I left Friday off a moment ago is because on Fridays it's a special All Access Mastery and XLT session. So on Monday through Thursday, if you're a Mastermind student, you can log in and join us. And then on Fridays, if you're an XLT student, you can come on in as well. We open up the doors to everybody. So it's a fun session. We'll have anywhere between 300 to 400 people in one of those sessions on a day-to-day basis. On Fridays, it can jump up as much as 700 to 800. As we allow XLT students in there. And the second instructor, when I pass the mic off, the second instructor will go through more specific trade setups. And if you're not able to make it because it is so early, I'm here in Texas, obviously Central Time. I go on the mic at 6:50, and I'm usually done by about 7:15, 7:20, and then the second instructor takes over, and then everybody's off into their trading day. So it's a
6:50 Central Time.
Yeah. So it's kind of early, considering that I also help manage the grid as well as write the daily market overview that's published on the website. So I have to get up at about 4 o'clock every morning to go through and make sure that all of that is published and in the system before I actually get on the mic.
That's just not right. No one should have to get up that early. And if you're teaching these at 6:30, that means I have to be up even earlier than that. 2 hours you got on me. I got to be up at 4:50.
Exactly. We don't have too many people in our sessions from California.
Imagine that.
But the sessions are archived, and I think it's worth going into and listening to. Today my commentary this morning from kind of a macro perspective was that this week is options expiration Friday. For monthly expirations on options, Friday's going to be the last trading day. Watch for some volatility. Bigger picture trends are still up. Look for retracements back down to demand zones to try and join those. And little did I know that today we would not only see a retracement, we would also start to see the bounce. Yeah. Because on Friday, both the Dow and the S&P 500 reached measured move targets that suggested that maybe we might actually go into a little bit of selling, and it all happened in one day.
Yeah, it was a real quick one. Like, here you go. Here's your little sell-off fan. No, we're done. Back up to highs. Fed will bail us out. All right, Scott. Well, hey, man, thank you so much. Sorry it's been 2 months. We'll hopefully get you back on in, what is it? This is August, so we'll get you on in September to do a kind of an update and see where we stand. But again, thank you for all your help that you do for the community and for coming on the show. I appreciate it.
My pleasure. Thanks for having me.
All right, take care. You too. Guys, that was Scott McCormick of Online Trading Academy. He's doing the GPS, which is Guided Pathway Sessions. As you can see, I think Lisa and Lori are in those sessions on a regular basis, as well as doing their own on Friday, I might add. Just great content out there. I can't make it live for sure, but I'll watch the recordings because Scott always has some little tidbits of information that I find extremely valuable. And a lot of times I'm not looking at all the information that I can be. Sometimes I might just flat out miss something that I might have overlooked. And Scott always seems to rein me in and say, look at this. Think about this real quick. Yeah, that's a good idea. So check those out if you guys have access to them. Other than that, he does a lot with the grid, and he used to do a bunch of XLTs, but now he's just really doing the grid and GPS as well as a few other things for OTA. But now we're going to actually start working on some other content as well. All right, let me look at what's happening out here for the calendar for tomorrow. Today's earnings were no big deal, really. BHP got butchered on their day, or the trading day. Here's what's cooking for tomorrow earning-wise, and this is important because before the market, you've got Grubhub, which is called, Just Eat Takeaway now. That's the name of the company. And Grubhub sounded so much better. You have Agilent and Cree reporting after market close, but before market opens, it's retail week. We have a lot of retailers reporting this week. You have Walmart and Home Depot reporting before market opens. That's the BMO there. I actually prefer when things are AMC, after market close. They tend to be more volatile. You notice that these New York stocks like Walmart and Home Depot, the reaction pre-market isn't really there. It's just not the same. But anyway, they're going to have their earnings before market open. That should be exciting. And then on the economic calendar front, it's a massive day tomorrow. There's huge information coming out Tuesday. The main things are at the top. I didn't highlight those, but you have retail sales numbers coming out. You have industrial production, capacity utilization rate, business inventories, and housing data coming out for the U.S. So huge day. And then down near the end, you actually have a pretty important announcement coming for New Zealand with their rate statement. They're actually expecting them to raise 25 basis points, which is kind of interesting. Now, maybe tapering is starting to move up and move up and move up. So we'll see if we actually get an end to this continual printing of money with the Fed with a raising of rates and see if that does anything. And of course, that'll start with New Zealand on Tuesday. Then maybe down the road in a few weeks here, we'll get the U.S. and see what their stance is. Also for the U.K., if you're trading British pound, which has not been the prettiest prettiest currency lately. It's been a lot of chop and kind of hard to trade. But the British pound has what I call Magnum PI Day, which is PPI, CPI, RPI, and I think that's it. CPI, PPI, RPI. I don't know. It's all kind of PMI. There's all kinds of MI days. It's all PI. It's all about the PIs on tomorrow's market. So that's pretty much it for your economic and earnings calendar for tomorrow. Hopefully, you guys got some good info from Scott and looking up the bonds, equities, currencies, and commodities. It's part of his regular routine, and I know that those of you who are in his guided pathway sessions know his dedication and how much he studies these markets. It's pretty impressive to find someone like Scott to come on the program and share his thoughts. So hopefully you guys enjoyed that one. Remainder of the week, I don't know if I have a guest. I don't know what's cooking for the rest of the week. I was going to take tomorrow off because I thought I had a leadership meeting, but that's actually next week, although I do have a big meeting tomorrow, so I might just keep it to a 30-minute show. We're talking about some new content stuff, so we'll see how tomorrow goes, but I will do a show for you guys tomorrow, and then maybe I'll get a guest on later this week. And I know I need to get... see, Brendan doesn't even show up anymore because I won't get Greg Manarino on the program. I just haven't gotten there. Do you need a crypto account to have a crypto credit card like Coinbase or something? No. I have the credit card I have is the BlockFi credit card, and that's just because it pays me in Bitcoin, which I love it. I mean, I just got my first statement, and I was paid in Bitcoin, and I'm already up like 10% on that payment that they gave me. It's like, great. Not going to happen with dollars in that account. But there's a bunch of different crypto credit cards out there for me. I chose the Bitcoin one. One that's pretty popular is the Crypto.com credit card. And they pay you in their native token interest rates. Plus, they have a whole slew of discounts and special perks. But I like the BlockFi one, so I went with that one. All right, you guys got any last minute? What time is it? If you have any last minute questions, go ahead and type them on in because I'm just about to wrap up here. If not, I will look at the chat and hopefully get them to tomorrow's show. I was supposed to have Sam Evans on last week, but I'm going to see if I can squeeze him in this week if he's got some time. He's super, super busy right now, as usual. We're always doing so many damn things. All right, well, that's going to do it for me, everybody. Hope you enjoyed today's show with Scott McCormick. Again, check him out at Online Trading Academy. You can go to their GPS, which is the Guided Pathway Sessions. Monday through Friday, he's doing those. And then Friday, I believe, was just is a general session for XLTs. Monday through Thursday is Mastermind. You got to have a Mastermind package to get in there. All right, that's going to do it. Hope you guys enjoyed it. Have a fantastic evening, everybody. I will see you mañana. Take care.